If you invested just $100 a week, it wouldn't feel life-changing at first. But over time, it can completely change your financial future and quietly build some serious wealth. I mean millions. And in this video, I'm going to show you exactly how this is done. Imagine you started investing just $100 a week at any point in the last 100 years. Not trying to time the market, not waiting on the perfect moment, just consistently showing up. Week after week, through the wars, the recoveries, the recessions, the bubbles, and the market crashes. What history shows us is that every rolling 20-year period in modern US market history, long-term investors were rewarded, no matter when you started. If you stayed invested for 2 decades, your money ended up higher than where you began. This includes some of the worst moments to be invested: the Great Depression, World War II, the dot-com crash, and the 2008 financial crisis. Over every full 20-year span, the market recovered, grew, and moved higher every single time. The volatility was temporary, that growth was permanent. So when people ask whether investing $100 in a week really matters, history already answers that question. For over a century, anyone who stayed consistent and gave their money 20 years to work was rewarded, not because they were lucky, but because they followed a system that has worked across generations. The biggest advantage you can have isn't starting with a lot of money, it's starting with a system. And $100 a week done the right way is far more powerful than most people realize. Whether investing $100 a week turns into something meaningful comes down to 3 things: time, return, and consistency. Time is how long you stay invested. Return is how much of your money earns each year. And consistency is what allows compounding to do that heavy lifting. Let's start with time. We are all starting from different places. Whether you're 20, 40, 60, or anywhere in between, the strategy can be adjusted to fit your time horizon. Next, we have return. Return is the annual percentage that your money earns on what you've invested. Now, this matters because it determines how powerful that compounding becomes over time. Later in this video, I'll show you exactly how this works and what those numbers really look like if you follow through with this. And then there's the most important factor of all: consistency. This is a non-negotiable. We're talking about investing, but this applies to everything in life. The grass isn't greener on the other side, it's greener where you water it. Health, wealth, relationships, finance, anything that you want to grow requires consistency. And when it comes to investing, consistency is what turns small, boring, weekly habits of investing $100 into long-term, life-changing results. Quick disclaimer, none of this is financial advice. I'm just a random guy on YouTube with the mic. So always do your own research before investing. And hey, this video took a ton of work to put together, so if you find any value here, hit that like button. It helps me more than you know. In this video, we're using $100 a week as an example, but the most important part isn't the number. It's starting and putting things in motion, no matter how much you began with. So if you can't do $100 a week, start with $50. If $50 feels like too much, start with $25. The amount matters far less than building that habit. Start where you are, not where you think you should be. Now let's put things into real numbers. Investing $100 a week comes out to about $5,200 a year. Over 20 years, that's roughly $104,000 of your own money that you have invested. Historically, the US stock market has delivered an average annual return in the range about 8 to 11% over long periods, and that's being conservative. Returns don't happen evenly year to year. Some years can be incredible and other years can feel brutal, but compounding doesn't care about that short-term noise. Your money doesn't just grow from what you put in, it grows from the return stacking on top of previous returns year after year. At a 10% annual return, if you invested $100 a week, after 20 years, you'd have around $312,000, and only about $104,000 of that came from you. After 30 years, that number jumps to roughly $900,000, with about $156,000 of your own money invested. This is where time starts doing that heavy lifting. Almost $1 million simply from consistency and holding an additional 10 years. Now let's take that up a notch. If you're willing to learn, do the research like you're doing now, and take calculated risks as a smart investor, investor, it's possible to push those returns higher. An average return of 13%, that same $100 a week then grows to about $450,000 in 20 years and nearly $1.6 million in 30 years. And that's a huge gap within those 10-year difference. All of that came from that one small consistent action of investing $100 a week. So the real question isn't if this works. History already proved that it does. The question is, how do we actually do this the right way? Well, when investing, especially starting out, I would look into ETFs so that you can spread your risk in a basket of companies versus betting on one single stock. Now, after you gain more experience, then you can look into single stocks and play around with your portfolio a bit more and maybe take more risk. But for this video, we will look at what historically works over the last century. ETFs act like a basket of stocks, letting you invest in multiple companies at once instead of betting on one. What I love about ETFs is that when one company struggles or fails, it is automatically replaced over time by a stronger business. You're not consistently making decisions or picking winners. The ETF does that work for you. One of the best performing consistent ETFs is the S&P 500. Now, when people talk about investing in the S&P 500, they're usually talking about one of three ETFs. We have VOO, IVV, or SPY. At their core, all three do the exact same thing. They track the S&P 500, which represents 500 of the largest and most profitable companies in the United States. Think Apple, Microsoft, Amazon, Google, Nvidia, really the backbone of the US economy. I'm personally invested in VOO, but you can look into any one of these. From a performance standpoint, VOO, IVV, and SPY all move almost identically over time because they track the same index. Investing in the S&P 500 has historically been a great way to grow your money over time. For those of you who are a bit more risk-seeking or already experienced and allocated well, there's also QQQ. Now, QQQ tracks the NASDAQ 100, not the S&P 500. So instead of owning 500 companies across the entire US economy, QQQ holds about 100 of the largest non-financial companies listed on the NASDAQ. This means they're far more growth and tech focused. When you buy QQQ, you're heavily investing in companies like Apple, Microsoft, Nvidia, Amazon, Meta, Google, Tesla, and other innovation-driven businesses. Technology makes up a large percentage of this fund, which is why QQQ has historically delivered high returns during strong bull markets compared to the S&P 500 like VOO. But that extra growth comes with more volatility. All investments carry risk, but QQQ tends to fall harder during market downturns because growth stocks are more sensitive to that rising interest rates or economic uncertainty and investor sentiment. I actually made a video called Buy These 4 ETFs Before the Next Market Crash, where I talk about ETFs that are worth investing in during uncertain times. I'll link that at the end of the video in case you want to watch that next. But when you invest in higher risk ETFs like the QQQ, you feel those swings more, both up and down. This also makes QQQ a powerful option for well-diversified portfolios, but not always a comfortable one. So here's how I would think about it in simple terms. VOO, IVV, and SPY, think broad exposure to the US economy, more diversified, and a smoother ride. Think QQQ as a concentrated bet on innovation, tech, AI, and growth. Higher upside, but bigger drawdowns. For long-term investors, QQQ can make for a good satellite position. That's something you layer on top of your core holding, which can be a VOO or IVV. That way, you still benefit from innovation and growth, but not all your eggs are in one sector. QQQ isn't better or worse, it's different. It's designed for investors who believe technology, AI, and innovation will continue to drive outsized growth over time and who can handle that type of volatility that comes with it. I'm also heavily invested in QQQ. You know what? I recently finished reading a book called Just Keep Buying by Nick Maggiulli. I think that's how you say it, which all boils down to how the best time to invest is always now, not waiting for a recession or a market crash, and how consistent buying always wins over time. So how do we set this up? The key to successfully investing $100 a week isn't willpower, it's automation. The goal is to build a system that runs in the background of your life so that you're not relying on motivation, market timing, or emotions. Once the system is set up, investing becomes boring, and that's exactly what you want. Start by deciding where your money will come from. So pick a specific account, usually a checking account, or it could be a savings, and treat that $100 like a bill that you have to pay yourself every week. Now, when it's automatic, you stop asking, should I invest this week? And that decision's already already made. Treat it like a bill or a subscription for something that you need to have. Next, you need to choose a brokerage account that supports reoccurring investments. Most of these major brokerages allow you to automatically invest a fixed dollar amount into an ETF every week. I use Fidelity, but you can use any brokerage account that supports this. That could be Fidelity, Charles Schwab, Vanguard, Robinhood. There's a bunch to choose from. This removes friction. There's no logging in, watching the market, no second guessing your decision when the markets look scary. Then decide on a simple investment plan. This could be one core ETF like a VOO, IVV, or a blend of VOO plus a small allocation to QQQ. The exact mix is far less important than sticking to it. The more complicated the plan, the more likely you are to abandon it. Once that's set, turn on automatic weekly investing in that brokerage account. The same amount, same day, every week. This is dollar cost averaging at its finest. When markets are up, you buy fewer shares. When markets are down, you buy more. You are removing the emotion from the process and letting time work for you. The final step, which is the hardest, is not to touch it. Don't pause contributions during market drops. Don't increase or decrease based on news. Don't check it every day. The entire point of this system is that it works precisely because you're not interfering with it. Over time, this system does something powerful. It turns your investing from a decision into a habit. And habits compound just like money does. $100 a week becomes automatic. Automatic becomes consistent, and consistent becomes wealth. That's how you invest $100 a week without thinking about it. And that's how real long-term wealth is actually built. If you then start earning more and you're able to invest more, you can always increase the contribution amount. Or you can stack up capital for a moment where fear is very high, like a recession or a market crash, and then buy more shares at a lower price and variable DCA into these major swings. Picture this: 3 different investors. One starts in 1928, right before the Great Depression. Another starts mid-1970s during the high inflation and economic uncertainty. And then the third one starts in the year 2000 at the peak of the dot-com bubble and then lives through that 2008 crash. All 3 of these investors experienced fear, losses on paper, and long stretches where it felt uncomfortable to continue to buy and hold. Yet 20 years later, every single one of them ended up with more money than they invested. Different paths, same outcome. The lesson is this: long-term investing doesn't depend on perfect timing, high income, or some kind of insider knowledge. It depends on time, return, and consistency. Time smooths out volatility, returns compound quietly in the background, and that consistency with that system that you just set up, that set it and forget it, allows you to buy through every market cycle, especially when the prices are lower and emotions are high. Not predicting the next crash, not finding the perfect stock, not waiting for the right time, just showing up week after week, year after year. So while most people hesitate, you stay consistent. While others wait for permission, you let time do the work. $100 a week does not look impressive in the moment. It won't make you feel rich tomorrow, but quietly it does build momentum. And momentum, given enough time, becomes freedom. The market will crash again. And when that happens, the system doesn't panic. It keeps buying. Because history has already shown us that those who stay consistent don't just survive, they benefit from them. So whether you're just starting, restarting, or finally committing to a system that works for you, remember this: you don't need to be early, you do not need to be perfect, you just need to be consistent. Because decades from now, when you look back, it won't be the week that changed your life. It'll be the habit that you never stopped. And that's how $100 a week quietly builds serious wealth. If you're still watching right now, please drop a fire emoji in the comments below. Let me see you. Make sure to check out this video next, and thank you so much for watching.